hold silver and gold as a fraction of your portfolio, no more than 5%. It will then serve its purpose if and when inflation accelerates.
Please join us for our next live stream Sunday, February 14th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, February 14th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you are new to our channel or if you haven't already done so, please do subscribe, hit the bell to be notified on new updates, and give us a thumbs up if you like what we do. We truly do appreciate your support. William L. Silber is our guest today. William is a senior advisor at Cornerstone Research. Prior to that, he was a Marcus Nadler Professor of Finance and Economics at the Stern School of Business at the New York University. During his career, he has made significant contributions in economics and finance and has provided expert witness testimony in class certification and at trials. In addition, he has written 8 books, the most recent being The Story of Silver, How the White Metal Shaped America and the Modern World, published in February by Princeton University Press. And we are delighted to have William back here today as a return guest on SBTV. It's time to saddle up and silver up for William Silber. William, welcome back to SBTV. How are you doing?
I'm doing fine. It's a pleasure to be back.
Glad to have you back, Bill. Our first interview, I think it went pretty well, where we talked about your book, which is right here, The Story of Silver. And I tell you what, the chapters on the Hunt brothers were pretty exciting, and I think we're kind of sort of seeing it all over again now. But what happened with the GameStop stock has hogged headlines recent weeks after surging nearly 700% in 2 weeks after retail traders piled in. So my question is, what do you make of this situation where retail traders trade up the share price of a business to levels that is no longer realistic of its valuation?
Well, this is not something that is unique. It is not something that was invented now. There are many historical examples of people buying and trying to push up stocks. And, the role of short sellers has in the past been quite under quite a bit of a cloud. Many government programs try to limit short sales, but in point of fact, short selling serves an important economic function. So, for example, companies that have these huge increase in prices over a very, very short time period may be able to raise capital at a very, very low rate and an inappropriately low rate. Or, for example, when there is a fraud, like in the case of Enron, where the share price doesn't reflect fundamentals, what short sellers do is keep the price within range so that those people who are taken in by the deception don't pay such a high price. So short selling goes against what investors like to see, but it serves an important function.
Yeah, it's a great point. And with GameStop, retail investors, they organized to buy the stock up in a Reddit group after identifying that the stock was the target of these short sellers. And their purchase of the stock has exacted substantial losses on hedge funds who were among the short sellers. What do you make of the situation where amateur traders are now moving stock prices even against the wishes of professionals and mathematicians on Wall Street?
Well, let me just say, first of all, there was something you said in that description, which, if it were true, would be dangerous, and that is that the retail investors on Reddit or colluded together, they joined together. That would be a problem, because collusion to move stock prices that you can be indicted for, and you can actually be fined and go to jail for that. So that's illegal. But simply to pile into a stock is not illegal. And for a short time period, for a day or two, or even a week, you can have the stock price not reflecting fundamental values. But once again, once people see that that's the case, short sellers, other short sellers can come back in. And we've seen that with GameStop. And that is, it did not take long for the price to begin to come back down. And look, financial markets always pit optimists versus pessimists. And that's the forum for getting out the fair price. So I don't particularly, unless there is collusion. If there's collusion, that requires some type of lawsuit that will eliminate the collusion. But absent collusion, I don't see any reason why they shouldn't fight it out, optimists versus pessimists.
Do you foresee this situation perhaps even escalating further and morphing into something more damaging for the stock market?
Bad news sells newspapers. So you see the violations of fair pricing getting the big headlines, but you don't see that very often. And the reason you don't see that very often is because most of the time we think stock market prices reflect the fair values. So every once in a while, when you see an anomaly like games, well, that's unusual. So I don't see this as being an attack on the integrity of financial markets. This was an unusual circumstance. If it happened every day in many, many different securities, that would be a different story. But it's an anomaly, and every once in a while, that happens.
How do you think regulators will act to address this issue?
I don't really see them doing anything unless they found collusion. If there was collusion, then there's going to be some follow-up lawsuits, number one. But in absent collusion, again, this is an anomaly. It's not something you see every day. You do not have headlines of these kinds of activities occurring in every single day. If you did, then you would have to worry about the integrity of the financial markets, and that would require perhaps some regulatory intervention. But as of now, I don't see this as something that is a continuous problem.
Okay. And the Robinhood app that was used to place orders suddenly did not allow new positions, did not allow long positions. And the only positions you could take or trade was to short silver. And the next day, they limited SLV positions to just 5 shares. Now, overall, your trade was limited to short silver. Do you find any similarities in this and how the Hunt brothers basically had to sell their silver positions as well?
Well, let me before we get to the
Sure.
Hunt brothers, let me just say that a brokerage firm normally will place higher cash requirements. We call that margin. Higher cash requirements depending upon how volatile a stock is. And the reason the brokerage firm does that is because the brokerage firm guarantees the payment of for securities and guarantees the payment to their counterparties. So in their own self-interest, exchanges as well as brokerage firms will raise the amount of money that you have to put down in order to buy or sell a security that is much more volatile. You have to put in a lot more money so that they can protect themselves. There is nothing wrong with that. In extreme cases, In extreme cases, they can also say, well, we don't want to actually do any business in this security. It is too risky for us guaranteeing those trades. So I don't think there is anything wrong or anything sinister in a brokerage firm putting up bigger capital requirements, requiring more cash for each trade, and or even restricting trades. So I don't see what Robinhood did in restricting trades in securities that are very, very volatile. I don't see there's anything wrong with that. So it's part of the volatility of a security. Very volatile securities require more cash balances by the customer.
There are already comparisons of what these retail traders did with what Wall Street has done for decades, using the stock market as a sort of casino. And it brings to remembrance the fallout from Wall Street's bets, which resulted in the 2008 financial crisis. The question is, why should regulators go to work now when retail investors are merely doing what Wall Street has been doing for decades?
Well, as I said, first of all, it's not clear to me that this is something that regulators are aiming at retail investors and not at professionals. There was a huge fallout from whatever problems people saw in 2008. So it's not as though this was just aimed at public investors. And so far, I don't see what public investors haven't been shut down. The only thing that's happened is the brokerage firm says, you're dealing in riskier stocks, you're going to have to put up more money, or you won't be able to trade those stocks, new positions in the stocks. We're not interested. It's too risky for us. But I don't see any special attack on new public investors. If anything, the fallout from 2008 was far greater.
Do you see this stock market bubble now sort of waiting to be pricked? And if it is to be pricked, what do you see as the pins to prick the stock market bubbles?
That's a great question, Patrick. The only word that I objected to in your question was the word bubble. And that's because we don't know what's a bubble until it bursts. I think the main motivation, the main factor behind the current rally on Wall Street is an old story, an old adage, and that is, don't fight the Fed. Don't fight the Fed. What that means is, when the central bank is easing credit, buy. When the central bank begins to tighten, sell. This is an ancient idiom in Wall Street. The big rally in the stock market began on March 23rd, 2020, when the Federal Reserve decided to push up asset prices. It continues today with very low interest rates. As long as interest rates are low and there are no alternatives to the stock market rally will continue. When you hear the Federal Reserve, or when you think the Federal Reserve is about to tighten, not that it's tightened already, about to tighten, that's when you have to sell. Right now, the Federal Reserve is not going to. So there can be some setbacks, further problems with a new coronavirus, a big bankruptcy. All of those could have the effect of driving down stock prices. But right now, the central bank is what's keeping stock prices high.
Why is it that even with zero interest rates, that the Fed keeps saying that inflation is not where their target rate is, and it seems they have problems stoking it?
Yes, I think that the Federal Reserve has made a mistake in saying that inflation has been too low for the past 10 years, which is what they've said. They want to have a higher inflation. They said it's been too low. In fact, over the past 10 years, the consumer price index has risen by 1.7% per year. The Fed's target is 2%. Those two numbers are virtually indistinguishable. Inflation can't be measured with the accuracy of an atomic clock. It is a measure. So I don't think inflation has been too low. And I think the Federal Reserve is making a mistake by trying to allow inflation to go higher than 2%. It's like, we'll wait until it's too high and then we're going to attack it. That's like closing the barn door after the horse has escaped.
Yeah, completely agree with that. So let's say the horses escape. Is anyone in the Fed capable of being a Paul Volcker, where they can appear at any time to address that inflation by hiking interest rates, perhaps by 10%, 15%? Is there anyone in there that can do that?
Well, the answer to that is we don't know, because what Paul Volcker did required one thing: backbone. We don't know to what extent the current Federal Reserve has backbone. And there is a big problem today, and that is the size of the government deficit is huge. And if the Federal Reserve allows interest rates to go up, Congress will not want the Federal Reserve to raise interest rates. That will have a huge drain on the Treasury. So I think it's going to be very difficult when the time comes for the Federal Reserve to raise interest rates as high as it might be necessary in order to keep inflation under control. I think it's much, much too early to talk about how high interest rates have to go. Right now, inflation doesn't seem to be a problem. We do see a big increase in the money supply, but that's just recent in the past year, the past 6 months, where it's been growing at 20%. We don't know to what extent people will want to spend that. So right now, that money supply that they have is like what I would call dry tinder. Like, you drop a match and then it will explode because it is ready to burn. We don't know. So I don't think it's time to tighten, but I think it's premature to say and incorrect to say we won't tighten until we see inflation starting to go up. And that's the mistake I think that the Federal Reserve right now is making.
How would such high rates start to impact pension funds?
Well, again, right now rates are so low. And pension funds have had to move into riskier assets compared to where they were before, because interest rates are so low. And to the extent that rates start to go up and pension funds have losses on their investments, that could create a potential for missing their obligations. So I think pension funds are vulnerable to high interest rates when that happens. It's not going to happen today, but when that happens, they will be vulnerable.
How about silver and gold? How would they be impacted by higher interest rates?
Well, we know that there are two effects here: higher inflation and bankruptcies will create demand for precious metals, as it has in the past. You remember 2011 during the European debt crisis. That was the last big rally in gold and silver. And that was when interest rates were much higher than they are today. So I think that higher interest rates normally hurt precious metals because you can hold something that earns money, but the fear of big bankruptcies and governments not being able to meet their obligations, that usually dominates. So inflationary pressures that drive up rates will in fact drive up precious metals until the central banks raise interest rates even higher than that in order to prevent a future further inflation.
We've been talking about the Fed here. Bill, is there any exit strategy at all that the Fed can employ to unwind its massive asset purchase measure without causing chaos in the markets?
Yeah, this is a big problem. I mean, the Federal Reserve owns such a large fraction of government debt. Even a hint that it will, what they call, taper their purchases can cause serious questions. We had that last in the end of 2019. And at the end of 2019, when the Federal Reserve said they were going to taper their purchases, you had a huge increase in interest rates. So I don't have a good answer for you. I really don't have an answer, except to say the Federal Reserve says, well, we don't see any reason to stop doing what we're doing. Of course, once the reason becomes clear, it's too late. So I don't have an answer for you. I would wait for the Federal Reserve to provide that answer.
And another, another answer the Federal Reserve may provide is central bank digital currencies. I'm sure you may have heard about this. What's your opinion on central bank digital currencies?
You know, the Federal Reserve has for a long time used electronic payments. It has its reserve balances are not physical bags of coins. They are electronic entries in the Federal Reserve's book entry system. So I don't see a radical difference between having some sort of cryptocurrency as a liability of the Fed versus what it is doing now, which is runs an electronic book, which has been around for decades. So I don't see that as a major change in how the Federal Reserve operates.
Major change. Let's say, other nations in the world, they've been wanting to get away from the U.S. dollar. Let's say it gets to a point where the U.S. dollar simply cannot remain the world's reserve currency any longer. Do you see that day coming? And when it does come, how do you think it's going to be in the U.S. where their dollar is not the reserve currency anymore?
Well, look, let me first say it is very difficult to dislodge the international money, the generally accepted medium of exchange between countries, the established medium of exchange, which is the dollar today, is very hard to overturn. Not only that, what is the alternative? I'm just going to give you a variant of what Winston Churchill said about democracy. Winston Churchill said, democracy is the worst system of government except for all the others. Well, the dollar right now is the worst currency except for all the others.
Bill, with all the money printing that's going on right now, do you see it as a form of currency debasement?
Well, in order to debase the currency, you need to see inflation. Just because they're printing money doesn't necessarily mean the currency is worth less. As long as prices remain under control, then the currency hasn't been debased. But there is sort of, as I said before, dry tinder. In other words, you have all this cash sitting around, which potentially can cause inflation. Until the inflation occurs, though, the debasement hasn't occurred.
Do you think we'll once again start to see these soaring silver prices like in the early 80s with the Hunt brothers buying only now it's the public who is looking to buy silver to protect against this form of currency debasement that may happen when inflation starts to kick in.
So you may not remember when I was on here 2 years ago, I recommended silver as a part of a portfolio. And 2 years ago, in March of 2019, silver was at a price of $15 an ounce. Now it's about $27 an ounce. That's about 80% higher, 40% a year. I think silver belongs in a portfolio as one asset among many, so that if you get runaway inflation, you are protected. I would not become obsessed. The Hunts became obsessed with silver. Instead of looking at it as an investment, it became an obsession, and that was their undoing. So I would still say hold silver and gold as a fraction of your portfolio, no more than 5%. It will then serve its purpose if and when inflation accelerates.
Okay. Bill, before we wrap up, can you let our listeners know more about your latest book? Let me grab it here. The Story of Silver, How the White Metal Shaped America and the Modern World.
Well, I can tell you a little bit of that book, but I have another one in the works. Another one in the works that's even broader. It is called The Power of Nothing to Lose. It's the Hail Mary effect. And I don't know if you guys know about Hail Marys over there, but so the Hail Mary effect in politics, war, and business. And it deals with how a nothing to lose attitude can in fact cause people to take very, very risky positions, like in a call option. And it applies that to politics, war, and business. It's coming out this summer, published by Morrow Press, which is a division of Harper and Collins. So that's the book that I would encourage your readers to look for during the summer. The Power of Nothing to Lose. How the Hail Mary effect in politics, war, in business.
It's a great title. We'll definitely be looking for that this summer. But Cornerstone Research, last time you're still with, I presume, the New York, right? Okay. Can you tell us about your work over at Cornerstone Research?
Well, Cornerstone Research is an economic consulting firm, and we do all sorts of different company litigation. So whenever there's a litigation, Cornerstone Research gets heavily involved in either the defendant side or the prosecuting side. So we do a lot of expert witness work for companies that are part of involved in litigation. And in fact, we just recently had a case being appealed to the Supreme Court, and we provided an amicus curiae, a friend of the court brief that is now being considered by the Supreme Court. So Cornerstone Research has a very, very strong imprint on economic consulting in general and litigation consulting in particular.
Okay, William Silber, we appreciate the time you've given us and hope we can do this again soon. And we'll talk about that book once it comes out. That was Professor William Silber, Senior Advisor at Cornerstone Research. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And to also check out the SBTV podcast on iTunes and Spotify.